Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TPG RE Finance Trust Inc. quarterly report. TPG RE Finance Trust, Inc. offers a diverse range of commercial real estate finance services, including origination and acquisition of commercial mortgage loans, investment in various debt instruments, such as subordinate mortgage interests, mezzanine loans, and secured real estate securities, note financing, and preferred equity investments, issuance of commercial collateralized loan obligations, close, and commercial mortgage-backed securities, CMBS, management of commercial real estate-related debt instruments. These services cater to various sectors including multifamily, life science, mixed-use, hospitality, self-storage, industrial, and office properties. The stock price of TPG RE Finance Trust, Inc. (TRTX) has experienced a modest increase in the past year, with a 1.25% rise as of October 2025. Several factors have contributed to this growth. Strong investment activity has driven TRTX's success, with a 12% year-over-year increase in its loan portfolio and a focus on multifamily and industrial assets. The company has also optimized its capital structure through the issuance of a $1.1 billion CRE CLO. Additionally, TRTX has implemented a share repurchase program, which has generated book value accretion and increased the company's book value per common share to $11.25. The positive reaction to Q2 2025 earnings release, where the company beat EPS and revenue estimates, also contributed to the stock price increase. Analysts have a positive outlook on TRTX, with an average one-year price target suggesting potential upside. Management forecasts annual EPS growth of 21.5% over the next 3 years, outpacing the broader U.S. market's projected pace. These factors have collectively contributed to TRTX's modest but steady stock price increase in the past year. The primary drivers of revenue growth or decline are primarily influenced by two key areas: net interest income and loan origination volumes. On the growth side, an increase in net interest income and loan origination volumes contribute to revenue expansion. Conversely, a decrease in net interest income and other revenue sources lead to revenue decline. Additionally, changes in credit loss expense due to improved asset-level performance also impact revenue. Overall, these factors play a significant role in determining the trajectory of revenue growth or decline. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between YTD 2024 and YTD 2025. Net income has decreased by $7,310,000 from $63.653 million to $56.343 million, indicating a decline in profitability. This decrease is also reflected in the profit margins, which have dropped from 37.7% net interest income margin and 26.3% operating profit margin in 2024 to 35.6% and 24.1% respectively in 2025. The reasons behind this shift are multifaceted. The decrease in net income can be attributed to the increase in operating expenses, which has likely contributed to the decline in profit margins. However, a slight improvement is observed in the last quarter of 2025, with a $1,568, 9.4% increase, rise in net income from June 30, 2025 to September 30, 2025. Overall, these changes suggest that the company's financial performance has experienced a decline in profitability and efficiency, warranting further analysis to identify areas for improvement. The company is generating a positive operating cash flow, as evident from multiple pages of the financial summary. Despite a slight decrease in net cash provided by operating activities from $86,634 in 2024 to $65,704 in 2025, the overall trend indicates a consistent generation of positive operating cash flow throughout various sections of the report. The company's debt level has experienced significant fluctuations over time. Notably, total debt increased by 14% from $2,571,655 to $2,946,804 as of September 30, 2025. However, there was a notable decrease in secured revolving credit facility from $86,625 to $213,031, minus 146% decrease. Collateralized loan obligations also saw an increase of 32%, Despite these changes, outstanding borrowings remain relatively stable. Interest expenses have shown mixed trends. While they increased due to accelerated unamortized deferred financing costs and weighted average interest rate increases, there were instances where they decreased by $17,057 or 7%. The debt-to-equity ratio and total leverage ratio have also increased by 23%, indicating a higher level of indebtedness. Management is emphasizing a cautious approach to the company's outlook. They aim to provide attractive returns through cash distributions and capital appreciation, while minimizing exposure to changing interest rates by matching duration with benchmark indices. To meet upcoming debt obligations, management plans to employ various strategies, including negotiating extensions, raising equity and debt capital, and selling assets. In terms of investment activity, management will moderate their investments due to market volatility and may restrain future investments due to increased costs and reduced availability of debt capital. The company's focus is on risk management, with a goal of maintaining stability in the face of potential market risks. The company has a history of paying dividends to its shareholders. In fact, it has been paying dividends for several years, with a dividend payout of $0.24 per common share in 2025. The total amount paid out in dividends was $68.8 million that year. In addition to paying dividends, the company has also bought back shares through various programs. Specifically, it repurchased up to $25 million of common stock under 2 share repurchase programs, with a remaining capacity of $25 million as of September 30, 2025. That concludes the financial summary for TPG RE Finance Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.